Volatility is not a pit, it's a ladder. The VIX goes up and down, but contango losses are forever. Volatility is not a pit, it's a ladder. The VIX goes up and down, but contango losses are forever.
All right, folks, welcome back. I wanted to discuss with you a trade idea. I do want to give you a disclaimer real quick. I am not a licensed. I'm not licensed to give trading advice, and if I were, I would not give it broadly on YouTube. I would give it specifically to a person. Everybody's situation is different, so this is just an example to give you ideas. Most people probably don't trade INSY. It is a therapeutic company that has gotten a lot of trouble in the last year and is still unclear if it's going to survive what's happened to it. But this is just an example of what you might do if you believe that a stock was going to go up sometime soon and you wanted a cost-efficient way of participating in the rally. So once again, INSY Therapeutics is what we're looking at right now, and it is a stock for a company. The CEO was busted. They were making they're caught up in the whole sort of fentanyl thing. I know a lot of people have heard about fentanyl. It's a drug that has been mixed in with like heroin, and a lot of people have OD'd on, and they have something that's very similar to it that they've been marketing, and they got in trouble because they were marketing it inappropriately. Like they're trying to sell as much of this drug as they could, but they were marketing it to like the wrong way towards cancer patients and whatnot. And the CEO ended up in handcuffs earlier this year, and they had to get a new CEO, and the stock price pretty much bottomed out. I think it bottomed out around $4. Let's just take a look at it real quick here. Now, once again, pick your stock. I'm just using this one as an example. So INSY, the chart over the last year doesn't tell the whole story. Let's look at 3 years here. All right, so 3 years. So it got up to $46 at one point. Got the really bad. No, I'm kind of right in the way of that. I apologize. Got the really bad news and seems to have bottomed out around 4 and change. This stock is kind of known as a marijuana stock because they have a couple products in the pipeline. The one that doesn't use like directly marijuana, but uses like cannabinoids, something or other to do with marijuana. So it's been widely grouped in marijuana stocks. And when there was hysterical buying of marijuana stocks, this stock got grouped in with a lot of those. But anyway, distressed stocks been down a lot. This is an example of one of those ones that I would not want to be putting my life savings or money into. It's more of a speculative type situation. It was up at $46. Could it go back there? It could. Is it going back there next week? Probably not. But is this something where you might want to bottom fish? Now, people were last year around this time, and like 6 months ago, we're bottom fishing. It got to a low of $4.10, as you can see on the screen there. And it's made a couple attempts at recovery already. And, it might be a good spot if you're going to speculate here. So how would you go about doing that with options? Well, take a look at the screen. Now, a lot of stocks that are this low in price don't even have options, but this one does. And a lot of marijuana stocks, quote-unquote marijuana stocks, don't have options, but this one does. So you could either buy the stock for $6, so 100 shares, or $6.86. So 100 shares cost you $686. Or you could buy a call, let's say the July's 54 days from now, so that's not too much time. But what if you bought a November call, 173 days from now? you could buy the November 7 call for $1.40. So to control 100 shares, instead of paying $685, you could pay $140. Now, to buy the November 7 call. Now, some people like to refer to this trade, buying a call, as leasing stock. And what you more accurately, what you're doing is you're leasing the right to buy the stock for 7. So if you were to buy the November 7 call for $1.40, if you buy one call for $1.40, you're actually going to multiply that number by 100 to figure out how much you're paying. So if you buy one call for $1.40, you're going to put out $140 plus commissions to buy that one call. And that one call is going to control 100 shares of stock. So if INSY is above 7 on expiration, then in November, 173 days from now, then that call can be turned into stock. And since these are American options, at any time before then you could turn it into stock, but you wouldn't want to do that. You'd rather just sell the call back out if the thing goes up, because you're going to lose some sort of premium. If you look at that 7 call, okay, the intrinsic value, by intrinsic value we mean what's the difference between the strike price and the stock? Well, what's the intrinsic value of that 7 call? Well, since stock is below 7 now, the intrinsic value is 0. Okay, the intrinsic value of the 6 call, however, since stock went out at 6.86, the intrinsic value of the 6 call is 86 cents. But you see, the 6 call has a higher price than 86 cents. There's some fluff in there between the intrinsic value and the actual value of the option. And that fluff, that's the difference between the intrinsic value and, between the strike price and the stock price, is the whole meat of what we trade with options. And it's due to many things. It's due to the leverage that that call creates, because the one neat thing about buying that 7 call is you don't have to turn it into stock. So, and the way that translates into operating is, if the stock goes down, the most you can lose is that $140. Whereas if you actually were to buy the stock for $6.85 right now, the most you could lose would be $6.85. So not only by buying the stock so what's the advantage of buying the stock? The advantage of buying the stock is you can hold on to it for a longer time. There's no expiration on owning the stock. What's the disadvantage? The disadvantage is you got to put out $686, and you could theoretically lose all that money if the company went bankrupt. Okay, what's the advantage of buying the call? The advantage of buying the call is it's like a third the price of the stock or more. It's a lot cheaper to buy 100 shares or to get the leverage of 100 shares. You're essentially leasing 100 shares. It's a lot cheaper to pay $140 for that call than it is $140 for that 100 shares than paying $686. So it would be a great deal for you to, if you have a good inkling that this thing is going up, and you have a limited amount of money, and it could be great to buy that call. Because let's say you have $1,000 in your mind that you want to play in INSY. Well, with that $1,000, you could buy less than 200 shares of the stock, but you could buy, like 5-6 calls with that $1,000, and give yourself a lot more chance of success if the stock does go higher. Now, what are some principles of owning this call? Well, it's slowly going to decay. So on expiration, if the stock stays at 686 from now to expiration, that call will slowly decay down from 140 to 0. And that's just the price you pay to play with that option. Now, let's talk about the market for the call, okay? The market on the screen is 110 bid at 140. Okay, if the markets were open right now and I wanted to buy one call, I would not go and bid 140. Not in a million years. Well, there is some circumstance where I would bid 140, but it would have to be when I was in super aggressive mode for a good reason. But with nothing going on, you can see on that screen there's several lines. The first line is the volume the last day it traded, and you can see in that November there's only been one option traded in November that whole day. And if you look at the next column over is the open interest. That's how many, what the open interest is in that option strike for since it started trading. So there's only 218 there's only 33 NOV 7 calls or open interest right now. That doesn't mean, it could have been that somebody, they were open contracts between people and they got closed out, but in all, it essentially means that it's a very low volume option. And so, thus, they are kind of wide, the bid-ask spread. But if I were you and I was going to try to buy one of these calls, I would not pay the offer. I'd go in somewhere in between. You'd probably be able to buy them for $1.30. You might be able to put $1.25 in and get filled right away. Getting filled means your trade goes through. But you usually can get stuff in the mid-market. So that's an example of how you can use options for leverage to own a stock. Thanks for watching, and I will see you next time.